Hey everyone, in today's video, I'm going to be talking about 3 stocks that I bought with $10,000 in my TFSA account. Now, if you didn't watch my last video, I recently sold a big tech position that didn't pay a dividend in my TFSA account for just over $10,000. And in this video, I'm going to share what 3 stocks I used the proceeds of that sale to buy. The first stock that you can see on the screen here is First Capital REIT. This is a retail REIT that operates flagship locations across Canada. As you can see on the screen, they trade for about a $3 billion market cap, 6% dividend yield, and they've been having a bit of a hard time the last few years after COVID with interest rates going up. Stock's gone down from the low 20s to the mid-teens at best here. So I thought with the 6% starting yield, it was a good opportunity to broaden my investment in this name. Taking a deeper look at the company here, they have really strong tenants. You can see from the top there, lots of grocery chains, lots of safe companies in terms of credit rating, like banks as well. They got Loblaw, Sobeys, Winners, Longos, RBI, which is like fast food companies, LCBO, which is the liquor board here in Ontario, Canadian Tire, Metro, etc. Walmart, you see there. So they have tier A tenants for the most part. Their top 10 tenants or top 20 tenants here only contribute 45% of their overall rent. So in addition to having a pretty good tenant book, they're also pretty well diversified. Going over into the types of properties that they own, if you're not familiar with First Capital as a REIT, their point of difference is they really prioritize buying locations and running locations that are in more well-off neighborhoods and more flagship locations. So as I just go through some of their assets here, you can kind of get a sense for the type of assets that they own. They do own some like shopping centers like this, but they don't have too many like malls. They have more kinds of real estate like this in downtown cores. They're increasingly developing more and more multi-residential on top of their real estate since they are in such good locations. But just hopefully this is giving you a general sense of the type of real estate they own. They own a lot of real estate in Yorkville, which is one of the most expensive retail streets in Canada. This isn't necessarily, when you think retail and you think shopping malls and the extinction of certain elements of retail, for the most part, they don't play directly in that kind of space. They're really more in cores and urban hubs. Now, looking at where First Capital owns their real estate, they have about 50% of their real estate worth, at least in Toronto. So really concentrated to the GTA. Also have about 20% out there in Alberta, 12% in Vancouver. You can see they only really play, for the most part, in the big cities. They only are, they're only in about 40 neighborhoods total. So they don't even diversify too much in terms of the areas that they're in. They really want to be in the wealthiest neighborhoods, central hubs that has lots of foot traffic and lots of high-income consumers going in and out of. And then lastly here, you can just see their funds from operation has been about $1 to $1.20. Current stock price of 14, so they're trading about 13 times earnings. It's a bit more expensive than some other retail REITs are currently, but I think it's really just goes back to the quality of their assets and the areas that they play in terms of type of retail real estate versus having a lot of mall exposure and stuff like that. So that's the first stock I bought here. In terms of how much of it I bought, going here, I bought about 250 shares, which is good for about $4,000 of the $10,000 I put here into First Capital. Stock number 2, and more of an ETF that I bought, was the BMO Covered Call Canadian Banks ETF. So this company or this ETF holds the big banks and then writes covered calls on them. You got a pretty good dividend yield, which I'll show you in a minute. They haven't been performing too well over the last number of years, but you have been getting about an 7 to 8% monthly dividend payout to hold the company. So you still made money if you've held it over the medium to long term, but just not exceeding returns to the market or anything like that. So this is really a bit of a cash flow play. It's a couple things I like about this stock, a couple things I don't. So we'll get into that now. If we look at some of the ETFs information here, they have a 7.4% distribution yield. If you were to buy a bank, you get anywhere between 4.5% to 6.5% at these levels. So you're getting a couple extra points of distribution from owning this security. What I don't like about it is you do have to pay a pretty high management fee, and that's just because this is a very hands-on ETF that they're running. So you're paying a 0.65 to 0.7% management fee that they take out of the premiums that they sell the covered calls for, going down to just what the holdings are here, and you won't be surprised, but it is a lot of TD, National Bank, Scotiabank, CIBC, Bank of Montreal, Royal Bank, and then just an ETF with all of them. So they just really hold the underlying stocks, and then we'll write covered calls to pay you out the premiums in addition to the dividends that these stocks do pay. So this is one that I like having in my portfolio for cash flow. It's more of a distribution. It's not an eligible dividend, so that's why I think it's better to hold this in my TFSA versus another account, and that's why I have it in this account and moving more of it into this account. Just going into some of their information on their fact sheet, and you can pause and read if you're really interested. But you can see here how the company's grown over the last 13 years or so. So $10,000 into about $25,000. I'm not sure how that does versus just owning the underlying banks. I bet you owning the underlying banks probably did better. But this is a bit more of a defensive play because even if the stocks go down in the short term, you're still getting that premium by selling the upside, even with the management fee. So just a bit of a different investment than owning the underlying securities. And I just really like it for income. I get more money and on a monthly basis flowing to my account for me to funnel into other stocks. And that's the main reason that I have this one. Looking at the performance, it hasn't been too great over the last couple months, but year to date up 5.5%. 10-year average is about 8% return, which definitely isn't too shabby at all. And then I think just this is pretty straightforward because they're only in the financial sector, only in Canada. So this is just an income play for me. It hasn't been doing well the last year or so. So hopefully the Canadian bank sector bounces back. And with that, this ETF will bounce back while they pay me upsized dividends. And in terms of this one here, I have bought in about 126, so about $2,000 worth of this one in my TFSA. So definitely not as big of an investment as First Capital or the third stock that I bought, but one that I wanted to get some more income flowing into my TFSA on a monthly basis. And the third and final stock that I bought this month with that $10,000 in my TFSA was A&W Royalty Income Fund. A&W is a quick service restaurant here in Canada. They currently get, I think, between a 3 and a 4% royalty off the top for every dollar spent at A&W restaurants. That currently equates to a 5.7% dividend yield on the stock. It gets paid out monthly. Looking at this one over the last 5 years, it's really stalled as well. If I look longer term, it was doing a great job from $13 all the way up to $40 of increasing equity value as they paid out that dividend with same-store sales growth. But what we've seen in the last couple of years is that sales growth and maybe optimistic future has just decelerated a bit. They're still growing, just not as fast. So I'm getting the company for about 20-25% off of what it was trading for before, despite them having a higher distribution on a monthly basis, higher royalties and revenues coming in. So I think this is a good opportunity, or has been a good opportunity to build a position in this name. Just looking a bit deeper at the company, they're the second largest burger company in Canada, behind McDonald's, I'm almost certain of. And they have pretty good diversification here, big presence in Alberta, BC, not like relative to lots of other Canadian businesses. having only about 30% of their business in Ontario means that they're pretty well diversified across some of the other major provinces as well, which I like to see. And then going into just some other information about the company, one thing I like about the company is look how much of their restaurants, about 600 of their 1,000 restaurants, are owned by franchisees who have 5 or more locations, which really proves the value equation of owning a franchise of A&W, in my opinion. And it really means that the vast majority of these businesses are run by people who know what they're doing, they've done it before, and hopefully that fuels a lot of growth in future franchisees. They almost have their own companies around running half a dozen or 10 A&Ws in a certain area, which I think is good for the brand and just good to have strong operators instead of 1,000 one-off people who may not know exactly what they're doing. So I also like to see this as well. Going into where they have restaurants. So they have about 1,000 restaurants here. 600 of them are freestanding restaurants. I think this is what the company was kind of like founded on almost, and it's a strong form of restaurant to have drive-through windows and whatnot, just in the corner of malls and things like that, and open plots of land. So that has been an area that has been growing over time. About 175 locations off of highways. So they kind of go into gas stations off of highways or en routes for people in Ontario that they call their convenience locations. Those are good businesses as well, with lots of people needing to travel on the highway system across the country. 95 urban locations. So these are small downtown locations. They used to have none of these like 4 or 5 years ago, I believe. So this has been built like from scratch. It's their highest growing area. I remember a couple years ago on an investor report, they're saying they had like 50 of these. Now they're already at 100. So looks like this is one of the areas they're trying to grow as the country urbanizes, more people moving to downtown cores, and those downtowns growing. They want to make sure they have a strong presence there. So I'll be looking at this number to grow. And then the one area that's been shrinking, probably for the better, is their shopping center locations. So these are obviously in food courts and stuff like that. I remember when I first started buying the stock, I think this number was closer to 200. So this has actually gone down in the recent quarter as some of the other methods have gone, or styles of restaurants have gone up. And each one of these locations are a profit center in their own right. So it's definitely good to hold on to as many as possible. But I think the urban locations, the freestanding restaurants are definitely more defensive, especially in an economic slowdown, than shopping center locations, which rely on people to go out, have the drive to spend their money on shopping and things like that to even be considered to go buy A&W in the center. So overall, I think that with the 5.7% yield, I'm getting a lot of income in my TFSA. In terms of how much of the stock I bought about 130 shares, so just about $4,000, same as First Capital. So if I was to break it all down, put $4,000 into A&W Royalty, $4,000 into First Capital, and then about $2,000 into ZWB for some enhanced bank covered call income. Overall, when I look at the 3 stocks that I bought, my mixed dividend across the 3 was about 6.2, 6.3%, and I invested about $10,000. So I went from having a growth stock that was sitting in there not paying me any dividends, holding up $10,000 in my TFSA, to now getting about $630 a year of incremental dividends in my TFSA that I won't have to pay tax on. I can take that $630, reinvest it in whatever opportunities I want, whether that's more dividend stocks or whatnot. So really happy I made this change. If you like these stocks or have anything to say about these stocks, I'd love to hear from you in the comments, and let me know what you're doing in your TFSA right now. Do you have growth stocks in your TFSA, or are you really prioritizing taking advantage of not having to pay the annual dividend or the annual taxes on dividends? Thank you guys for watching. If you like this type of content, be sure to give this video a big thumbs up. It really does help with the YouTube algorithm. Also consider subscribing to the channel if you haven't already, and I'll see you guys in the next one.